Well, JPMorgan coming out strong in the second quarter, thanks in part to higher interest rates. Profit at the bank jumping 67%, lifted by the company's acquisition of the failed First Republic Bank in early May. Yahoo Finance's executive editor Brian Sozzi is here in studio with the details and everything that you need to know. Hey, Soz.
Yeah, this quarter certainly, I think, checked a lot of boxes if you are, in fact, a JPMorgan bull, guys. First up, as you've been talking about all morning long, First Republic, if you go down this earnings release, big highlight, they saw $2.4 billion in income from First Republic alone. That probably reflects a lot of the exposure of First Republic to higher earning or higher or wealthier families. That is in large part why JPMorgan came out and bought this asset at distressed levels a couple months ago. On a media call, they shared this interesting stat that I thought was pretty cool. They've seen $6 billion in deposit inflows. That is First Republic since the closure of that transaction. So if one was concerned that more about deposits flying out of that asset post JPMorgan life, they tried to put that to rest. But there's more going on in this quarter for JPMorgan besides this First Republic. You had Jamie Dimon, CEO of JPMorgan, calling out consumer resilience. On that media call, our very own banking reporter David Hollerith got a question to CFO Jeffrey Barnum, and he noted he's not seeing any consumer lending tightening, still expects a robust outlook for loan growth and consumer spending. That was a highlight for me. And then, of course, the outlook. Wow, this was a big outlook. JPMorgan net interest income about $87 billion now for this year. Previously, they were looking for $81 billion. So a lot of boxes checked right here and some of those boxes right there.
You know, what stood out to me, too, is that in the statement, Jamie Dimon called out potential regulatory pressures, right? And this is really was thrown into focus this week by Michael Barr, the vice chair for supervision at the Federal Reserve, making comments earlier in the week talking about the additional capital requirements that are going to be necessary for banks. In the statement, Dimon talks about the potential that this is going to happen. He says, we'll manage through it, whatever it is. But he said, we caution that material regulatory changes would likely have real-world consequences for markets and end users. Now, undoubtedly, he's right. This is something we've been talking a lot about, potential regulation. At the same time, it's a little rich that he's saying this, given the quarter that this bank has just had. Oh, poor us. What are we going to do if regulation comes? I think you're going to be just fine.
Right on, Julie. I mean, that's what I'm talking about. Right, and it was interesting. I actually teed this question up to Jamie Dimon was calling into the media call from Europe. He was on there with Jeffrey Barnum, the CFO. I thought he would have answered the question I asked him on these very Basel III, given his comments on the earnings release. Barnum took that question, kind of downplayed, I would say, the potential impact, but again, really drove home the fact that if these requirements go into effect, that would be about a 20% increase among larger banks in the capital they're supposed to hold on their balance sheets. That it might impact the economy, it might impact financial markets. But again, that's a lot of if.
I mean, just one more figure here from this quarter. The company got a 25% return on tangible common equity.
Huge. Mm-hmm.
That is huge. And so much bigger than the other banks that reported.
Yeah, I mean, I'm still just kind of latching on to some of the consumer statements that you were making from the bank. And Jamie Dimon basically saying within this that the economy continues to be resilient, consumer balance sheets remaining healthy. Consumers are spending, albeit a little bit more slowly. And it's going to be interesting as we go on throughout earnings season where it shows up that consumers are spending a little bit more slowly. We had JPMorgan's Jordan Jackson on with us earlier this week who said the consumer, and as he was describing them, they are bending, but they're not breaking. But even as you're having some type of decision-making be needed to employed by consumers, where does that mean they're trading off or trading down even more?
Very interesting start to earnings season this week. PepsiCo CFO Hugh Johnston came on our network yesterday talking about a lot of consumer resilience, paying more for snacks. You talked to Delta CEO Ed Bastian, striking upbeat tone on demand. And then you have earnings results out of JPMorgan and Wells Fargo, which we'll get to, telling you that the consumer is not completely falling apart. Both companies showed strong volume growth in their credit card businesses. Now, autos wasn't good. Home lending not so good because of higher rates. But again, consumers are at least out there buying stuff, whether it is trips and maybe to a lesser extent clothing.
Yeah, so let's get into Wells Fargo. What stood out to you?
Stood out to me, like I just mentioned, consumer demand holding up pretty well. Home lending down 13%. Maybe that probably is to be expected given rates have come. But by and large, this was a commercial real estate focused earnings release from a Wells Fargo, and they raised their outlook. But again, a lot of focus on commercial real estate, taking a $949 million allowance for credit losses, mostly as it pertains to commercial real estate loans. Now, I asked CFO Mike Santomassimo this morning on the media call, what are you seeing in commercial real estate? Now, he did not say that they're seeing zombie buildings out there or people completely delay payments. This reserve really reflects what could happen in the months and quarters to come, given the elevated levels of interest rates and the impact that has on commercial real estate. But I wouldn't say alarming just yet. Wells Fargo went a long way to say this is not a systemic problem yet, but we'll be saying this in 2024 to be determined.
Yeah, most definitely. So this morning, I just want to round it out and talk about Citigroup myself because I was looking at some of the numbers there. It's interesting this morning because we have the number one credit card issuer in JPMorgan and the number two in Citigroup reporting their numbers. And in the case of Citi, that company doing well as customers are borrowing more. They're putting more on their credit cards. At the same time, there was a 78% surge in write-offs tied to consumer loans. So that is quite interesting here. The people are putting more on the credit cards, but there are also not the same repayment rate that we had been seeing with that. 11% jump in revenue from U.S. personal banking, in particular for Citi in the second quarter. And overall, the company beat estimates by 2 cents a share, even as expenses rose by 9%.
I'm a little sad today, guys. Jamie Dimon only answered one question on the media call. I was looking for something big from him, calling out maybe 7% interest rates or something that could really get me excited for the weekend and everything I do to prepare for the week ahead. And he didn't give it to me. I'm bummed out.
And Jane Frazier's not dumping in here.
I needed something, Brad.
It looks like CFO Mark Mason is the one who's answering questions.
Yeah, I needed something negative or extremely positive. Jamie Dimon really didn't give me any of that. But I'm going to listen to your analyst call soon.
The numbers are pretty positive.
Yeah, I don't know. You're always looking for that next big thing in journalism, that next big story. And Jamie didn't give it to me. So
you can comb through the balance sheets this weekend. Plenty of time.
All right, fine, fair enough.
Yeah. All right. Soz, thanks so much for joining us this morning.
Great to be here.
All right.